Picture a young couple at what should be a peak life moment. They hold down solid jobs, earn a healthy combined income, pay their rent on time every single month, and they are finally ready to buy their first home. Then, the loan officer slides a piece of paper across the desk. They are either rejected entirely or offered an interest rate so high that the monthly payments price them out of the neighborhood completely. They leave the office confused. There is a common assumption in America that if you make good money and have money sitting in a savings account, lenders will automatically trust you. But for lenders, your salary is secondary to a single three-digit number that dictates whether they are willing to take a risk on you: your credit score. Earning a high salary offers zero protection if a mismanaged credit score is quietly destroying a bank's trust in you. To see exactly where this couple went wrong, we have to open up the black box of that three-digit number. This diagram shows how a standard credit report works. Think of it as a strict financial resume. It pulls in your personal data, every open account, and a history of who has asked for your information, and presents it all neatly organized for a lender to evaluate. Lenders weigh sheer reliability above all else. That large 35% section highlighted here is your payment history. It is the single largest piece of the credit score algorithm. In our couple's case, one partner forgot a single student loan payment during a busy month last year. That one isolated mistake acts as a heavy anchor, dragging down the most critical metric on their profile. This gauge illustrates the second largest factor in the formula: credit utilization. This makes up 30% of your score, and it measures a simple ratio: how much credit you have available versus how much you are actively using. To pay for their wedding, the couple put everything on one credit card, pushing the balance to its absolute limit. They assumed that because they planned to pay it off entirely in a few months, their score would be safe. The algorithm does not factor in good intentions. Between payment history and credit utilization, 65% of a person's financial reputation comes down to a strict mathematical ratio of debt to limits and historical reliability. This timeline measures another widely misunderstood factor: length of credit history, which makes up 15% of the score. Institutional trust requires time. Trying to be responsible, one partner recently called their bank and closed their very first credit card because they hadn't used it since college. By removing that old account, they wiped out years of established positive history. The final 20% of the calculation looks at new credit and your credit mix. When an underwriter sees someone asking for multiple new lines of credit in a very short time, it signals financial stress. To furnish their new home, the couple applied for a few different store credit cards to get a 10% discount at checkout. Each application triggered a hard inquiry, dinging their score right before they walked into the mortgage office. These side-by-side bar charts project the real-world penalty of those combined errors. The difference in the total interest paid over 30 years between a fair credit score and a very good credit score is massive, often totaling tens of thousands of dollars. Normal, everyday choices, like closing an unused account to tidy up finances or trying to save a little cash on a couch, can trigger severe algorithmic penalties. Minor consumer habits quickly escalate into lifelong financial burdens. They set out on a strategic turnaround plan. First, they pulled official credit reports to check for errors, then started aggressively paying down that wedding card to lower utilization. Next, they set up automatic monthly drafts for every single bill. This permanently locked down that heavy 35% payment history metric, removing any chance for human error. They froze all new credit applications entirely, ignoring store discounts at the register. They also left their remaining older accounts open and active, giving the length and inquiry metrics time to slowly heal. After several months of targeted, disciplined behavior, their score finally migrated out of the fair tier and into the very good range. They returned to the lender, secured a mortgage with a significantly lower interest rate, and finally moved forward with the purchase. The algorithm responds strictly to data inputs. By aligning your habits with these 5 specific metrics, you shift from being a passive subject of the score to an active manager of your own borrowing power. By understanding the rules, anyone can dismantle these invisible roadblocks and build a path to lasting financial flexibility.